Ever wondered why some people effortlessly build wealth while others struggle? The secret lies in understanding one simple concept: the difference between assets and liabilities. Stay tuned, because today we're breaking down this crucial financial lesson to set you on the path to financial freedom. Hi everyone, welcome back to our channel. If you're new here, don't forget to hit that subscribe button and turn on notifications so you never miss out on our latest videos. Today, we're diving deep into a fundamental concept of personal finance that can make or break your financial future. Assets versus liabilities. What are assets and liabilities? Put simply, the difference between assets and liabilities is straightforward. Assets are items that bring money into your pocket, while liabilities are items that take money out. The goal is to accumulate as many assets and as few liabilities as possible. The misunderstanding. Let's clear up a common misconception. Many people believe that buying a house is an asset. However, unless you plan to sell the property, it is a liability due to ongoing costs like mortgage payments and maintenance. Conversely, if you intend to resell the property at a higher price, it can be considered an asset. Think about it. A house will cost you money for years, with no immediate return on investment unless you sell it. On the other hand, if you purchase a house to rent out, the rental income can turn it into an asset. Investments as assets. Think of assets as investments, things that can make you more money than what you initially spent. For instance, buying stocks, shares, and bonds means acquiring assets because they generate income through dividends or can be sold for a profit. Let's break it down with an example. When you buy stocks, you own a small portion of a company. If the company does well, the value of your stocks increases. Additionally, many companies pay dividends, which is a share of their profits paid out to stockholders. This means you earn money both from the increased value of your stocks and from the dividends. The car dilemma. Is a car an asset? Typically, no. A car's value drops significantly the moment you drive it off the lot. Used cars are worth much less than new ones, so it seems unreasonable to consider them assets. However, some argue that since you can resell a car, it qualifies as an asset. But a good asset should generate profit. A car that rapidly depreciates doesn't fit this criteria. Of course, there are exceptions like historic or collectible cars that can appreciate in value. But for everyday use, cars are generally liabilities. Tangible versus intangible assets. Tangible assets are physical and can be touched and interacted with, such as land, property, equipment, cash, and inventory. Intangible assets, on the other hand, are non-physical and include things like brands, patents, and copyrights. For example, owning a patent on a popular invention can be highly profitable, even though it's not something you can physically touch. These intangible assets can be incredibly valuable and often provide significant financial returns. Financial versus real assets. Real assets have intrinsic value, which is their true value independent of market conditions. Financial assets derive their value from market trading prices. This distinction is crucial for investors. Real assets include things like real estate and commodities. These have inherent value because they are tangible and useful. Financial assets, such as stocks and bonds, are based on contractual claims, and their value fluctuates with the market. This is why investors like Warren Buffett emphasize finding the intrinsic value of a company to determine if a stock is overpriced. Stocks. The mother of all assets. Stocks, also known as shares, represent a fraction of a company. When you buy a stock, you're essentially purchasing a small percentage of that company. There are primarily two ways to profit from stocks: capital gains and dividends. Capital gains mean buying a stock at a low price and selling it at a higher price. For example, you might buy a stock for $5 and sell it for $7, making a profit of $2. Dividends are issued periodically and represent your share of the company's profits. Let's break this down further. Buying a stock makes you an associate of the company. If you own enough shares, you may even gain voting rights on important company decisions. The value of stocks fluctuates based on market demand and supply. The more in demand a stock is, the higher its price will be. Real estate as an asset. Real estate can be an asset if you buy underpriced properties to resell or rent. This concept, though simple in theory, is complex in practice and involves factors like timing, location, and economic indicators. As a real estate investor, you start by searching for underpriced properties. Underpriced means a property with potential that has been mismanaged, leading to a lower price. You fix these issues and sell the property at a higher price. Fixing issues can include modernizing, repainting, or adding furniture. Instead of reselling, you could also rent out the property after fixing it, providing a steady income. Real estate investments require significant capital, knowledge, and confidence. Alternatively, you could invest in real estate investment trusts, REITs. With REITs, you trust a company to invest your money in real estate, and in return, you receive dividends. Knowledge as an asset. Absolutely. Knowledge is an intangible asset. By learning a valuable skill, you can become the asset. The more expertise you acquire, the more valuable you become in the marketplace. For instance, if you own a marketing company, you can hire talented individuals whose skills become your assets. The better your salespeople, the more clients you gain and the more money you make. This applies to individuals too. By learning a valuable skill that entrepreneurs need to grow their businesses, you become more valuable in the job market. Understanding the difference between assets and liabilities is crucial for building wealth. Focus on acquiring more assets and minimizing liabilities to secure your financial future. If you found this video helpful, give it a thumbs up, comment below with your thoughts, and don't forget to subscribe and turn on notifications for more financial insights. Thanks for watching and see you next time.